We have Aditya Narain of Edelweiss now joining us to take some questions. Aditya, great to have you with us here as always. Appreciate it. I mean, that same question to you, how much is in the price, right? I mean, isn't that the question always? But what is where do you stand on that at this juncture?
I'd say a little bit is probably in the price, and very often it's the early stage of the rising cycle. Which is most disruptive for equity prices. But I do think you need to distinguish a little bit between what's happening in the US and what's happening in India. As far as the US is concerned, you do have a rising rate cycle. The Fed has come out pretty aggressively saying that we continue to hike. But the reality is that is a red hot economy from a demand perspective, right? If you were to juxtapose that against India, you're probably at an earlier stage in terms of a rate hike cycle. You've not really seen anything. But the reality is, as far as demand is concerned, it is pretty lukewarm at this point in time. So the risk that you have to start raising rates in India, and that risk is clearly now much more exaggerated than a month or so ago, would mean that the demand cycle could be a little bit more vulnerable, given that it's not even taken off as yet. So in that context, I think it would be too sanguine to say that it's all already in the price. It would, of course, be too cautious to say that, this is only the beginning and markets will be inversely related to the rate high cycle. But I would say, you still need to remain a little cautious, given that in India, at least, we are not seeing the elements of demand that we thought we'd see by this stage.
Well, Aditya, the earnings that we've gotten so far, a couple of index heavyweights, we've had Infosys, TCS, as well as HDFC Bank report numbers. From other sectors, we've had Nestle report numbers as well from the Nifty, and a couple of mid-cap IT companies as well. We'll talk about that in just a bit. But from the numbers that we have so far, there hasn't been any blowout performance. In fact, most of the numbers were at best in line or maybe below par. And even inline numbers saw stocks getting sold into. Now this is the start of the result season. Going forward, only worse is likely to be expected. Is that what you would believe as well?
Well, I wouldn't take such strong stances as if only the worst is to be expected, or the starting point that none of them had blowout numbers. To some extent, I think the market reaction that you've seen is really a reflection of what people are expecting, which is kind of blowout numbers. And you're going to get good numbers. The numbers are not really out of sync with what people are kind of expecting. Because there is an underlying assumption, either just in terms of general optimism or as reflected in valuations, that you're going to get blowout numbers, that when those don't come through, you have a massive reversal. So quite honestly, if you were to look at the start of the earnings cycle, I don't think the numbers are bad, but I think what has clearly happened is that the mood has clearly turned down, and that doesn't augur well for the rest of the earnings cycle, because if you meet, the stock price misses, right? And so if the presumption is that you're going to get blowout numbers and that's what's required to hold the market, or those respective stocks, then you have a little bit of a challenge, right? Now, the expectation that has to some extent been built up is blowout numbers. And those are hard to deliver. Even as good numbers are being delivered, they're not particularly disappointing numbers by any stretch of imagination so far in any case.
The IT index, and I'm going to ask you to comment specifically on this space, Aditya, was down 5.5% this week. Reema is here to tell us more in terms of what happened. Reema.
Thanks so much for that. Big fall seen in the IT stocks this week. In fact, the Nifty IT index itself is down close to about 5.5%. Year to date, it's now the worst performing index with a cut of close to about 16%. Now, we had many IT companies report their numbers this week, and most of them were disappointing. So in the large cap space, you had HCL Technology, a miss on revenues and miss on margins. On the mid cap end of trade, you had L&T Infotech and L&T Technology both missing the mark on the revenue front. Met street expectations, but there was no big beat. Cyient was the only one which managed to top street expectations, while Tata Elxsi as well clocked in a good performance. The problem is growth rates are slowing down for the company at a time when the supply side challenges are putting a cap on the margins. So take a look at the growth rates for the companies in the March quarter and compare it with the December quarter, and you would see growth rates have fallen. Now, for instance, HCL Tech in the December quarter grew 1.3%. This quarter it's down to 0.5%. L&T Infotech growth rate has fallen from 8.5% down to about 3%. So that's the reason why we've seen stocks getting punished. Growth rates is slowing down. There are margin pressures, and plus the cost of equity is going up, which is crunching the valuations as well. So year to date, you've seen most of the IT stocks decline anywhere between 20 to 30%.
Rima, thanks very much for that. Aditya, your thoughts? I mean, people have been complaining that valuations are very high and there should be an opportunity when there's a dip. Well, we have a dip. What does one do about it?
So yeah, as far as the IT space is concerned, and we've been out there flagging it as something that we are actually very comfortable with. So the last week or so has not really worked for our portfolio or our call. But I'd go beyond what Rima basically said, that as far as the demand side is concerned, while clearly there has been a little bit of a dip in terms of revenue growth, I would suspect a lot of that has come from execution challenges rather than the nature of demand or what lies up ahead. So I would say the demand side remains relatively robust. The supply side has clearly been more of a challenge, one in terms of pricing, which shows through in margins, but I think also in terms of execution disruptions, right? Now, the way I would tend to look at it is that at the end of the day, it's the demand comfort which is what is more important, because that ends up being the driver of whether it is valuations or profits, right? The supply side is something that there is a timing element. Obviously, it's getting pushed out further in terms of wage costs, wage pressures easing, but that tends to be more a quarterly kind of phenomenon which you can live through, right? So bottom line is, it's been tough for this space. I don't see any real big drivers in the immediate term for this sector. But I think fundamentally, in terms of how those businesses are stacked up, the demand side seems comfortable for a sustainable period of time. The supply side is hurting a little bit more than was expected. But I would suspect that's something that you can be a little bit more patient about. And you will have these stocks to play with again. But again, you have to remember, as again Rima flagged, that the backdrop is high valuations. The backdrop is that rates are rising. The backdrop is that global recovery could be, or global growth could be, at a little bit of risk. And so generally at a market level, you need to be a little bit more cautious and a little bit more greedy in terms of in terms of valuations. And potentially that holds the same for IT stocks too.
All right, we take that point, but one stock that rallied over 9% this week, hit a fresh record high, was Reliance, and this was on account of multiple factors. One, there was high capacity utilization for the company. Singapore gross refining margins were at near all-time high, heady Jio subscriber additions as well in terms of active subscribers. And then we had a brokerage note on their green business as well, a Morgan Stanley estimation of a near $25 billion potential for its hydrogen business. What caused this rally on the stock and what were the reasons behind that? Sonal Bhutra joins in with the details, and then we get cracking on Reliance with Aditya after that. Sonal.
That's right, a big mover this week. Reliance was up almost 10%, and a couple of reasons why this happened. Fundamentally, Singapore GRMs, they are at $18 per barrel, which is at a multi-year high and compares with a 5-year average of $4.2 per barrel. Reliance Industries GRM, they trade at a premium to Singapore GRM, so definitely this number will look really good for the company. IIFL in its recent note said that Reliance Industries, with its integrated O2C revenue model, outshines all the peers, and that's why they are bullish on the stock. Additionally, Morgan Stanley also increased target price on Reliance this time around. They from 2,926 rupees per share to around 30 to 50 rupees per share. They think multifaceted hydrogen boost for company will be around a $25 billion potential. They expect 10% boost to RIL's NAV because of this, and hydrogen segment can give them ROCE of around 14 to 15%. And despite the capex in this field, they think that the debt for the company will be range bound, and that's why they are bullish on the stock.
All right, we take that point. Aditya, what are your thoughts? Because, I mean, at times it makes sense to have so many moving parts, right? Because something or the other will always move.
So you guys missed quoting us. We had actually updated the stock about a month ago, with an extreme focus as far as the hydrogen opportunity is concerned. But I think that's one element of it. That is what provides you a certain amount of support in terms of valuations and a growth leg. But I think the bigger thing that is playing for Reliance is that, at the end of the day, what has happened with this whole Ukraine issue is that energy and energy security has all got valued up. And while this might be a little temporary, it's not something which you will measure in terms of quarters. It's something that will last a much longer period of time. So you have Reliance, which is fundamentally very, very well placed. You have a situation where the bulk of their cash flows really come from the energy paradigm, whether it is gas, whether it is GRMs, and now they're complementing it with hydrogen. So I think the shift that has happened in the need for energy security, and obviously the pricing benefit that is coming through for it, plus the support of the fact that the bulk of this company at the end of the day is from a cash flow perspective positioned there, and from a growth perspective also positioned there. I think that plays through very well. So I think it's this bigger picture positioning and some of the initiatives and the cash that is going to be thrown out from their existing leadership positions. I think that's playing to their benefit. Just if we were to go back, I think we downgraded the stock about 2.5 years ago, when there was just too much expectation on the digital and the retail sides. And in many ways, the stock did nothing for the last 2 years. It underperformed pretty substantially, simply because the steam was being run out there, and now you have a new driver of growth. So I think it's the right area to grow in. And being in an area of business which is working well in the current global economic and political cycle.
All right, Aditya, well put. Thank you very much for joining us with all that perspective. Great to have you with us here on this edition of Taking Stock. Thanks. Have a good weekend. We'll see you back soon enough. We'll take a break here. We are back and